Hello, everybody. This is Toni Turner, and welcome to the Market Now on Friday, March 14th at about 12:30 p.m. Eastern. Well, U.S. consumer sentiment fell in March, and inflation expectations rose amid worries that U.S. tariffs would boost prices and undercut the economy. The University of Michigan surveys of consumers said this morning its consumer sentiment index dropped to 57.9 this month, from a final reading of 64.7 in February. However, the market's up so far today, so we'll see what happens. So let's go on and look at three charts that could give us some insight in the next week. First of all, as we always do, we're going to look at a daily chart of the S&P 500 SPDR, symbol SPY. As you all know, this is the exchange-traded fund that closely follows our benchmark S&P 500 index. And now as traders, especially in times like these, we watch the SPY because, as I've always told you, in bull markets, 3 out of 5 stocks will follow the S&P 500 higher, while in bear markets, we're not in a bear market yet, but we're certainly in a correcting market so far. In a market that's going lower like this, 4 out of 5 stocks will follow the S&P 500 lower. So it gives us the mood and manner of the stock market, which is especially valuable to traders. So when I captured this chart today, the SPY was trading at $561.24. That's about 9% below its recent all-time closing high on February 19th. At $612.93. Of course, right now the SPY is trading below its 50-day moving average, coming in at 592.52. Or I'm going to round some of these off as I speak. So the 50-day right now is coming in at 592. The 20-day is coming in at 584. 200-day, the black line, is coming in at 572. And again, we're all the way down here at 561 and change. Now, as we know, look left on the charts, since the SPY has gone from walking up its 20-day moving average, and it did so to a great degree, as I've told you before, for most of the time since November of 2023, we basically, and of course it pulls back at times, absolutely, but basically walked in an uptrend since November 2023 with a total gain of 66% up to the recent highs. So you can't really fault it now for pulling back. I know that we have many reasons we assign to the reasons these markets falls, and that happens we always do give it reasons, and certainly it's been uncertain out there lately. But after going up for 2 years, 66%, let me tell you, it's going to have a pullback. It's going to happen. It's a natural thing. So anyway, we know that back in December of 2024, the SPY touched a new all-time closing high back in December at 607.81. And from that relatively calm uptrend, where basically the SPY was walking up the 20-day moving average, not all, but a lot of the time, this is when all the fun started right here. This is when the volatility came in. It dove down on September 20th, down to a December low down here at $580.91, then rallied back up to the 20-day. See how it hits that 20-day, gets hit on the head, and it can't go any further, to $601.34. Then fell again, then rallied back up to 600, then fell to the January 13th low, down here at 575, then rallied straight back up again, and then started consolidating. Along, not a beautiful consolidation, but nevertheless going sideways along the 50-day moving average till we ran up again to our new all-time closing high at $619.23. Then that was all we could handle. And from there, the SPY took a dumpster dive down all the way through the 20-day, the 50-day moving average, down through the 200-day moving average, again, down to where we are now at $561.24. Now, we can see now, we say, well, how's it going to get back up? Well, that's what we're going to watch next week. We say, well, where is the resistance coming in? So I'll draw some for you. We have price resistance, if I can draw a straight line. Price resistance from October lows. I thought those October lows were going to provide support, but once price fell down through these October lows, you see right here, all the way over, once price fell through it, then that number becomes resistance. What was support becomes resistance. That's the way it goes. So we've got resistance here at 568. We've got more potential resistance at the 200-day moving average at 572. Then we've got the January lows here at 575. We've got the 20-day. Now look, when we're down here at 561 for the SPY right now, and we're looking up here at the 20-day moving average, we can call it resistance, but right at the moment it's really not important because this 20-day, because by the time the SPY gets back up to that 20-day moving average, the 20-day is going to be in a different spot because, of course, it's moved around by the price and where the price goes. If price comes higher, it'll maybe start to soften up and go sideways here. If price goes lower from in next week, if the SPY goes lower, then the 20-day will keep on heading down overhead. So we can say that when price gets to the 20-day may cause some resistance. At the moment, it's at 584 and change. Ditto for the 50-day, which is at 592 and change. We have more price resistance. That doesn't move up back over here and all the way up to the highs again at 614. So this 614 is going to be probably a challenge when, and I'm going to say when, not if, the SPY gets to it. So there's a lot going on here. So next week, I want you guys to be very careful. We do have potential nearby support here at 550. So that's where I'm going to draw my line for, is the for a potential bottom, or as we call it as traders, a tradable bottom, which means maybe it rallies up a little bit. We buy a little bit. When it rallies up, we jump out, and then it falls back. It could do that. Right now, it remains to be seen what will happen. So we've got, again, potential support at 550 and potentially, hopefully, we don't need it. The September low from way back here at 539, it's there. Hopefully, we don't need it. Hopefully, it doesn't get there. So, okay, next week, if we do get a tradable bottom here, meaning it starts to go higher, maybe I'll dip my toe in it. If it falls back down, I'm back to the sidelines again. Again, there's a lot going on right now, so please be patient. Remember, cash is a position, and lost profits are a lot cheaper than lost money. So please be patient and keep an eye on your protective stops. Our next chart today is a daily chart of the Invesco QQQ, symbol QQQ. This is the ETF that follows the NASDAQ 100, the top 100 non-financial stocks in the NASDAQ stock market, including the large cap momentum stocks like NVIDIA, Meta, Apple, Tesla, that whole group. Now, when I captured this chart today, the Qs were trading at $477.90. This is 11%, definitely in correction territory, 11% below the all-time closing high back here on February 19th at $539.52. So we know that since back here, since the December high at 538, the Qs, like the SPY, similar patterns, only the Qs are always much more volatile than the SPY. So, because they're tech stocks, they're the naughty kids. So, we know that since the December high at 538, The Qs fell down to 509, down to the 50-day moving average, rallied to 531, then down to the January low down here at 499.70. I'm going to call this 500 to make it easier to remember, because that's about what it is. Then it rallied up to 533, so this was all fun, but then it gapped down below the 50-day, down to 510. So we can draw lines all along here if we want to. Then up and consolidated, a lot more volatile than the S&P, but consolidated along its 50-day moving average, and then finally moved up again to its all-time closing high on February 19th at 539, then rolled over. The Qs did its dumpster dive down here to where we are now, again at $477.90. So looking forward here, we say, what does it have to get through to get back up? So there is potential resistance here at 400 and well, wait a minute. We've got October lows. Where's the October lows? We thought they were support, but now they become resistance. So that is, the October lows are at 483. So that's pretty good. October lows could offer potential resistance. And you say, what in the world do October lows have to do with it? Well, a lot of people who bought here said, well, I rode the ride all the way up to the highs and then it crashed. So if I ever get even, I'm going to get out and stay out. So that means that if price goes back up to October lows, there may be some selling there. That's all. Then we have potential resistance at 493 from the 200-day moving average. We have, of course, the 20-day and 50-day are way up here. Again, not important where they are now. It will be, though, when price gets back up to them and see if they act as resistance. We do have the January low here at 500, so that could cause a little bit of pain. Then we've got higher up to 510, then the 50-day moving average, potential resistance when it gets there, then up to back up. Then there's more resistance, obviously, moving up price resistance back up to the prior high at 539, 540. So we'll worry about that when we get there. We've just got to get back up through all these price the resistance levels to get back where we were. So we do have here potential price support at these lows at 466. So this is the low I'm watching now, 466 for the Qs. We do have, if we want to look left, we do have September lows at 448. I refuse to worry about that right now. So I'll worry about it when and if we get there. So in the next week, and this is a big if the Qs start higher, if they hold this low here, and if they start higher, then I may dip, as I said before with this SPY, I may dip my toe in, but it's going to be with the mindset of a short-term trade, whatever I get into, and my share size will be smaller than it usually is, and I will use hard stops. I'm not willing to lose money in this market. So please be careful out there and use hard stops. Our final chart today, something we haven't looked at in a long time. Look how calm this is. It's like there's a hurricane and tornadoes all around us, and then there's the insurance ETF. Sort of like utilities. We got into the CGW last week, and that held up very well, one of the water ETFs. This is a daily chart of the SPDR S&P Insurance ETF, symbol KIE. It has 53 holdings. Top holdings include Bright House Financial, Globe Life, Arthur J. Gallagher and Company, Palomar, Progressive, and I did note that the fund has all buy signals on it, and it certainly is pleasant to look at this chart as opposed to some of the other ones we have out right now in the text and so forth. Now, it made an all-time high right here. The KIE made an all-time high right here on November 24th at $62. Then it fell down from there. Most everything fell in this part of the year, but it fell down from there in waves, not directly down, in waves, down to right here, then rallied up, then kept on going and fell down to the 200-day moving average. Note how that kind of acted as support right there. And that was down to $53.73. Then rallied back up again above the 20-day, which was inverted by then under the 50-day. Rallied back up to the 20-day and started making kind of a positive sideways consolidation here over the 50-day, over the 20-day. They finally got back to more a bullish stance, and then it rallied, made a little quick move up here to $60.81, then came back down to its current price. So again, this looks like calm in the middle of a storm. So if the SPY, and I told you it's an if the SPY holds those lows we talked about a few minutes ago in the coming week, and if the KIE, which is right now trading at $58.64, if it can stay above its 50-day moving average, which is coming in at $57.67, if it can stay above that, I may buy a position of the KIE in my trading portfolio, and I'll put a stop in right here. It's be below the 50-day right here at $56.50. Now, if you'd rather put your stop down under the 200-day moving average coming in at $55.72, I do not blame you. Go ahead, either one. And then if and when the KIE can get up here and close above 61, that's what I want. I want it above 61. If it can close above it, I will add to my position, and of course by then my stop will be a trailing stop. So you may want to keep an eye, if the SPY behaves, you may want to keep an eye on the KIE in the coming week. I'm trying to take us to a place that is a little safer than the usual places to be out there. Okay, and now, I think you all know this, please know that at ToniTurner.com we've lowered the price of all of our online training programs to make them more accessible to everyone. So if you'd like to become a more profitable trader, this is the best time to check out my timeless training programs. I'm going to talk again this week about how to bottom fish like a pro, because there's a lot of opportunities out there when the market starts higher to get some bottom fishing done and profit from it. Learn how to bottom fish like a pro, is the perfect training program to help you start buying low and selling high right now. You'll discover how to recognize key trend reversal signals, target high opportunity entry points, and how to manage the trade to take the best profits from uptrends. Our new low price for this program is only $199, and you'll receive special bonuses when you order, including 1 month of Metastock daily charts or Metastock real-time charts for free. And once you purchase, you have unlimited access to learn at your own pace. So from our ever-popular 7 steps to successful trading, and down to how to swing trades successfully, how to trade the trend to profits. This is going to be another one that's going to come in so handy in the upcoming market moves. How to read charts, something you really want to make sure you know about. 3 winning setups, great for short-term traders. And again, our bottom fish like a pro, which is really something to learn right now. Find out how my online programs can help you earn more money quickly and easily. Check them out right now by going to the link on this screen, or easier still, just click on the orange button below. Until next week, be careful out there. Keep green on your screen. I'm Toni Turner, and this is The Market Now.